Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. We've got an hour to go in the trading day. You're looking at the major averages not too far from the flat line as investors really turn their attention ahead to later this week when we will be getting some data out on inflation. But for the day today, the Dow off just 40 points, S&P up about 0.1%. The Nasdaq, the outperformer of the three major averages. We also want to turn your attention to the latest in regional banks. Now, PacWest today is leading the charge to the upside. The rebound rally really extending from what we saw on Friday. Now, the move today coming after the bank announced it will cut its quarterly dividend down from 25 cents a share down to a penny a share. You're looking at a gain of just about 6%. A number of some of the other names within the space, Western Alliance was one of the names that was being down pretty badly last week in the wake of the regional bank sell-off. That stock up just about 3% today. Zion's Bancorp up about 4%. Putting this all in perspective, though, we're still seeing very significant losses over the past 5 days. But Akiko, when it comes to this move here from PacWest, obviously Wall Street a bit encouraged here from this move. We had RBC analyst John Arfstrom, who was out with the note saying that the dividend reduction makes sense and can potentially help with the pace of capital building. Obviously, PacWest had to adjust and shift its strategy given what has really transpired over the last 7 to 8 weeks. So a cut in dividend could help better position the company, at least in the short term.
Yeah, and we heard from the company announcing that slash in its dividend, saying essentially what they've been repeating, which is that they are in fact fundamentally sound when you look at their balance sheet. I would suggest, though, that the confidence in the regional banks not entirely back yet. When you look at where the ETFs are trading right now, the KBW Regional Banking Index, one we've been watching very closely here over the course of last week, when we saw that big sell-off. Take a look, it is still down about 1% there. So there's still a lot of questions here about which banks are sound, although, you know, we had analysts on last week, Shauna, that said it doesn't really jive with when you look at where the numbers are for these banks versus where the sentiment is in the market. So we've got to bounce back for one day. But to your point, we have seen some significant declines. So really still a long way to go until they get back to that level. Well, Chicago Fed President Austin Goolsbee joined Yahoo Finance for a one-on-one interview with Jennifer Schomburger, and she joins us now to break down that conversation. Jen, we were just talking about the regional banks. Certainly, Austin Goolsbee making some comments or weighing in on that. What were your key takeaways from the interview?
Hey there, Akiko. In an exclusive interview, Chicago Fed President Austin Goolsbee warned the beginning of a credit crunch is starting and that a recession is a possibility now.
Well, I'm certainly getting vibes, as you are, in the market and in the business context that the credit crunch, or at least a credit squeeze, is beginning. I think you have to say that recession is a possibility. You got a lot of major forecasters forecasting a mild recession already for the second half of the year. So I think that's got to be on everyone's mind. And in a way, you do not land the plane nose down.
Goolsbee also says he's seeing signs of cooling in the job market. He said he likes to scrutinize the job market over 3 months and look at the total hours worked by everyone in the economy, not just the number of jobs created. And based on that, he says the total hours worked has not been growing as strong as overall job growth would suggest, noting that it looks like some of the froth in the job market is cooling off. Now, Goolsbee, who served as chairman of the Council of Economic Advisors under President Obama and witnessed a debt ceiling showdown that saw the U.S. credit rating downgraded, says the argument over the debt ceiling now comes at, quote, the worst possible time. He says it tacks uncertainty onto credit tightening. He's worried we're going to reignite stresses in banking where financial institutions use Treasury as their collateral. Now, while Goolsbee is worried about a credit crunch, the debt ceiling, and cooling in the job market, he stopped short on saying whether the Fed should pause right now ahead of that next Fed meeting, given that there's so much time between now and mid-June and therefore so much more data that could come out. Guys?
Yeah, Jen, it was a great interview there. Does anything else just stand out to you in terms of what the Fed is looking at or plans to look at ahead of its next meeting?
I think the major thing that they're watching right now is credit conditions. You heard that from Fed Chair Powell last week. You heard it again from Goolsbee today. He's really focused on credit tightening and what that's going to mean for monetary policy. They're also closely looking at the job market. Of course, in addition to those inflation numbers, I also just want to point out it's interesting that ahead of the last meeting, Goolsbee struck a bit of a cautious note as he did today in my interview, yet he voted in favor of raising rates by 25 basis points at that last meeting. And he told me the reason for that is that he didn't see that credit tightening really taking hold and impacting the real economy right now. And so he decided to really just stick with the playbook. Of course, they are going to be watching how that permeates between now and mid-June, and still quite a bit of time there as we see more data roll in.
All right, Jen Schonberger bringing us that interview with Austin Goolsbee. Thanks so much for that. Well, with the ongoing U.S. banking crisis, investors are searching for answers and new opportunities amid the volatility. Joining us now is Andrew Slyman, Morgan Stanley Investment Management Managing Director and Senior Portfolio Manager. It's good to talk to you today. Let me just get your take, first of all, on what we heard from Austin Goolsbee, saying that he's starting to see some of that credit squeeze happening or credit tightening. What does that mean from a market perspective as you're watching it?
Well, it is pretty amazing all we've gone through year to date, and yet the S&P is up 7-8% for the year. I think it shows incredible resilience. Is the market sitting around waiting for resolution about the economy? I'm not so sure. I think it's that the stock market's had 2 years of going nowhere, and there's probably a high level of selling exhaustion, which is really keeping the market from trading down on bad news. Doesn't necessarily mean the market will go higher, but it just definitely keeps keeps a floor in the market.
Andrew, do you think that there is a slight risk here that the market, though, is being too complacent, given the fact that we've seen stress in the banking system? Signs here, some are saying that we're in the midst or starting to see a credit crunch. And then we also have the standoff going on down in D.C. over the debt ceiling.
I think that's absolutely right. I'm worried. Short term, I'm worried because Congress usually doesn't act until financial markets really force them to act. And I think Congress is looking at the market going, well, nothing to worry about. So as we get closer to the date, I suspect you'll see some more volatility, which is code word for the market going down, which will force action. So yeah, I am short-term nervous that the market is taking this all in stride and doesn't believe that there will be a funding issue and they'll come to resolution. And I bet they will. It's just only when they start to worry about the volatility they're causing.
Yeah, I mean, how significant a risk are we talking about right now? I mean, the choppiness we have seen, sure, this week we're focused on politics. Last week it was the banks. But as a market event, how significant is this as we get closer to the June 1st?
Well, the market never reacts the same way twice, and it overreacted to the funding crisis in 2011. We had a big drawdown, and then they came to a resolution, and the market came roaring back. So I don't think we'll see that level. The second thing is I go back to the market's gone nowhere for 2 years, so I have a hard time seeing people say, okay, now's the time I'm going to give up. I've stuck through 2 years of going nowhere. I'm giving up on the market. I have a hard time seeing it. I just don't see it in flows where there's actually people pulling. I just think we're caught in this range. Could we trade down to the lower end of the range, 3,800? I think that's a possibility, but I don't think we're going to retest the October lows. And I have a hard time until later this year seeing the market break to the upside, which I think will happen, but it's premature, and we've got this debt issue in front of us.
Yeah, massive debt issue just a few weeks ahead here. Andrew, so then what should investors then be doing at a time like this? There's so much uncertainty. It doesn't sound like you think we're going to see a heck of a lot of movement, at least in the short term. Should investors be staying on the sideline or at least leaving their portfolio untouched? Well,
there's invested and then there's not invested. And the number one thing I worry is that I hear a lot of people say to me, well, I'm going to commit when we get this drawdown that so many people on Wall Street are predicting. That hasn't happened this year. They've been predicting it since the beginning of the year. I don't think we're going back to retest the low. So my worry is a lot of cash waiting for a retest. I don't think it's coming. If you're invested, I think it's going to be I don't think we're going to be much further ahead than we are now. Come, September, I think it's going to be a good third and fourth quarter because the market's going to start to price in a reacceleration in earnings next year. It's just premature now. So if I'm wrong and we have a bigger drawdown this summer, I doubt it. But if it happened, then I would look to put money to work. But I certainly wouldn't pull out the errors. Look at what's happened so far this year. It's a great little analogy. Last year, energy was the best performing sector. And as we came into this year, a lot of people liked energy stocks. It's the worst performing sector this year. Stock market did poorly last year, came into this year, a lot of people negative. It's done well. So the message is trying to time the market is a fool's game. And I would be careful on getting out, then you get back in, given the fact that the stock market has gone nowhere for 2 years, and usually in that type of period, it's only time until it breaks to the upside.
Yeah, don't try to time the market. That's consistent messaging that we've heard over the years. Andrew, you talked about opportunities in the U.S. What about outside of the U.S.? We've had a number of guests who said they are starting to see some opportunities pop up, especially in emerging markets. What are you watching?
Sure. So first of all, China, the Chinese market rallied 100% off the low from October until end of January. And now it's retraced a portion of that. And I think a lot of people are throwing in the towel. And I think it rallied too quickly it takes time for an economy to reopen after COVID. So I think that market still, you have a government that's trying to stimulate their economy. You have a central bank that's stimulating the economy. I think that's intriguing, but you have geopolitical risks there. So you have to be careful on how much you invest in a part of the world. I think Europe is attractive because the dollar, after going, vertical for a very long time, which really killed non-U.S. investments, I think Europe is attractive also because it is a play on an opening in China, and valuations are very cheap because people expected a nasty winter, and it turned out not to be the case. So I'm more optimistic near term on emerging markets in Europe than I am on at least the S&P cap weighted.
Some good takeaways there. Andrew Sliman from Morgan Stanley. Great to talk to you today. Appreciate the time. Well, we are just getting started here on Yahoo Finance. Still to come, what we learned from the Berkshire Hathaway annual shareholder meeting. Plus, the debt ceiling showdown. Eurasia Group President Ian Bremmer is going to be weighing in on what the standoff could mean for the U.S. on the world stage. And more earnings ahead. We've got Lucid and PayPal reporting after the bell today, and Disney due out on Wednesday. We have you covered with what to watch on all of those reports. Stick around.
big push by the Biden administration to address flying frustrations ahead of the busy summer travel season. Now, the government is now proposing airlines compensating passengers for some canceled and delayed flights. Diane Kinghall joins us now with more on that. And Diane, we were just hearing from the president in the last hour and Transportation Secretary Pete Buttigieg.
Yep.
What have we learned?
Oh, that's right. All right. So the Biden administration is coming down on the airline industry today. The Department of Transportation says it wants to issue new rules to require carriers to compensate travelers for things like hotels, meals, and rebooking travel when flights are delayed or canceled for 3 hours or more. The caveat being that it has to be an issue that is the airline's fault. Earlier today, President Biden held a press conference about the proposals and had this to say. Let's listen.
Your time matters. Impact on your life matters. Later this year, my administration will propose a historic new rule that will make it mandatory, not voluntary, but mandatory, for all U.S. airlines to compensate you with meals, hotels, taxis, ride shares, and rebooking fees, and cash, miles, and/or travel vouchers whenever they're the ones to blame.
So the administration has beefed up its Department of Transportation customer service page, if you will, flightrights.gov, to show which carriers exercise some of the practices it wants to mandate, because some of these carriers, many actually do these practices, such as offering rebooking on their airline, though, covering hotel stays and or vouchers to cover meals, but none offer cash compensation for delays. So it seems that a lot of this, which is done in spirit, now the government is trying to regulate.
Yeah, so, I mean, that begs the question, why is the administration trying to step in now? What about the timing of all of this?
Well, Akiko, you'll recall that during the president's State of the Union address earlier this year, he talked about junk fees. And among those were fees within the airline industry, such as those family fees. And he wanted transparency within that sector of family seating, whereas families would get charged for sitting apart. And now the idea is that more families won't have to suffer and deal with those kind of fees. A few airlines have taken note and made changes. And you're looking at some of the airline stocks right there on the board right now. It's not having really an impact on most of the shares of these companies. We have some other news within the airline industry that seems to be affecting those. So I think what that has to do with is really it doesn't change the order of operations or the order of business for how many of these airlines operate. A lot of these already offer things like this in principle. So clearly the administration trying to codify this, but also clearly with President Biden announcing that he's up for re-election, it's definitely to court more favor with voters.
All right, Diane Kinghall, thanks so much for
that
update. We want to stick with the airlines here because airline stocks are on a bit of a move here. There was a new note out from JP Chase. Now, the banking giant turning bullish on American Airlines, upgrading the airline to overweight from neutral while raising its price target to $29 from $26 a share. Now saying in this note, quote, it's now the larger airlines that control the high ground. And Akiko, when we take a look at American specifically and what JP Morgan liked about American, they mentioned the revenue guides, the margin improvement, the fact that the company posted a $10 million profit last quarter. Revenue was up 37%. A lot of that strength, Akiko, coming from the demand to travel internationally as we do see more and more COVID restrictions lifted worldwide. People are back out. They want to travel international. And we're seeing that reflected not only in Americans' plans, but from a number of its competitors as well.
Yeah, I mean, when you think about where JP Morgan is coming in overweight, they were already overweight the other carriers. So American Airlines just joining the pack here, but it really is about the domestic versus international. Obviously, the discount carriers don't have that. So we are seeing that dynamic shift in a big way. You talk about the debt picture for American Airlines, significant improvement on that front, 60% on their way to completing its goal of cutting debt by $15 billion by the end of 2025. JP Morgan saying in this note that, yes, that's a good thing. It doesn't mean that things are fixed, but they are on track here at a quicker rate in terms of addressing that debt.
Yeah, certainly. And we can see, obviously, JP Morgan, they're not alone in the optimistic view that they have for a number of the larger carriers here in the U.S. But Akiko, also on this note, JP Morgan didn't really have the same rosy picture or outlook, I should say, for some of those discount airlines. Particularly, you're looking at Southwest. They downgraded that stock to neutral from overweight, also reduced their price target to $39 a share from $64. Southwest shares hovering near the flat line. Less than an hour here to go before the bell, off just about 0.2 0.2%. They also downgraded Frontier as well, just saying that the path forward here is a little bit less clear for some of those discount airlines.
Yeah, I mean, Southwest, of course, coming off of a bumpy, no pun intended really here, but a bumpy ride for that airline when we're talking about delays and challenges with travelers. So that's already, in some ways, we've already seen that way on the stock. But when you think about how things are shaping up for the summer, Shana, we keep hearing that there is really this demand that consumers are still willing to shell out money for that big summer travel. It's going to be interesting to me to watch. I mean, we're obviously seeing where the note is saying that they think international demand is continuing to stay strong. I mean, those tickets, I don't know if you've been searching, but they are not cheap. I'd be curious to see to what extent that demand continues, especially in the face of inflation.
Yeah, Kiko, I'm so happy you brought that up because it has certainly been astonishing. We're talking about the fact that Americans are facing higher prices in nearly every aspect on their life. They're pulling back in many situations on their discretionary spending. When you take a look at airfares, they're up, about 30% still on a year-over-year basis. Those international flights are very, very expensive. So I would not be shocked if some people are forced to, unfortunately, maybe change their travel plans over the coming months, given the fact that inflation remains so sticky. All right, well, coming up, Warren Buffett's big bet on oil. We will break down the top takeaways from Berkshire Hathaway's annual shareholder meeting. Stick around.
Warren Buffett is putting an end to speculation that Berkshire Hathaway might buy Occidental. The CEO saying, quote, "We are not going to be making an offer for control of Occidental." You can see shares are almost 2%, almost down 2%, I should say. Now 3% here on the news. For more, we're joined by Lee Munson, Portfolio Wealth Advisors President and CIO. Lee, good to talk to you today. This is a stock that was one of the best performing in the S&P 500 last year. It is down already. Are you still bullish on Occidental even after what we heard from Warren Buffett over the weekend?
Yeah, let's think about what we know about Warren Buffett, okay? He's got about a quarter of the shares. He's authorized to buy half of it. And he's got warrants at $59, right, where he can buy a ton of it. He's got some preferred stock that he's making 8% yield. I mean, in this market, when we're expecting, earnings to be a little flat, maybe a mild recession, why is he in such a big hurry? But here's the thing. What we do know is where he'd like to buy the stock, and it's around that $59 where he has the warrants. So why is he going to go in and say, hey, I want to pay a big, 10, 20, 30% premium when he can sit around all year and accumulate the stock? So I don't necessarily look at this as a negative. I don't think I think it just tells you that right around here is a good and fair value that he's comfortable with. And I think that that's all there really is to read into it. And he loves the CEO. He loves how that company is run. And that's what we're supposed to glean from his comments, not that there's going to be some easy money. As if we go and listen on Saturday for stock picks, right? That's not what the point of the Berkshire annual meeting is. It's to try to get some sense of wisdom from these two old guys.
Yeah, Lee, that's interesting because when you take a look at this share reaction today, you would think that maybe it brought some fear out there among shareholders just in terms of what exactly the future looks like for Occidental. But it sounds like what you're saying is that some of these people that have possibly been chasing Buffett here, buying in on Occidental Petroleum, they shouldn't necessarily be discouraged by this news. Rather, they should be encouraged by how well positioned he thinks the company currently is, right?
Yeah, and also that he likes the valuation, right? I mean, if you're a value investor, you don't want the stock to jump up all at first. You want to be able to accumulate it at a reasonable price. Remember, this is a guy who has about 20 to 25% of the company right now. And he might buy up to half of it. And I know he says, well, we wouldn't know what to do with it right now, right? We don't want to take over the whole firm. He didn't say he doesn't want to accumulate more, but he did make it very clear it's hard for him to want to buy the whole company when he's going to be giving up a bunch of yield. So I think you just have to think about what his psychology is, right? He's not here to give you a hot stock pick. He's not here to make you rich on some sort of buyout rumor. What he's here to do is he's accumulating companies that he thinks that you can compound in the future and make a lot of money. And when he says the words, we've got all these warrants around $59, and he says, oh, we're comforted. We like that we have all these warrants. We like that we can buy it at roughly the price it's trading at today, right? So if he likes $59, that means that we should like $59 and consider accumulating. If you're looking to buy an individual stock in the energy arena, I would agree and say that this is probably one of your better bets.
Yeah, Lee, you could argue that Warren Buffett, sort of a calming voice over the weekend in light of the choppiness that we saw last week, especially with the banks. Apple specifically, he highlighted that we know he's added to those holdings recently, but he said, look, this is a better company than any we own. In fact, he said, I made some mistakes a few years ago when I sold shares when I shouldn't have. I'm curious what stood out to you in some of those comments that we got from him on that space, because you talk about him value investing. I mean, Apple has been steady value for him.
Well, it has. And I think it should suggest that, when he says, I don't know what interest rates are going to be in 5 or 10 years. I don't know. I think there's another company, he says, I think it might have been Ford Motor Company or Tesla or something like that, where he says, I don't know where it's going to be in 5 or 10 years. But he said, I believe I know where Apple is going to be 5 to 10 years from now. And what he means when he says that, the way I interpret that, because I've been, reading his annual shareholder letter forever, I've been watching this stuff since I was a little kid, he believes that Apple will still be able to compound at a reasonable rate of return. In fact, he thinks Apple is his best compounder right now, right? And so when he thinks that he has that future sight, I think that what it means is that you can tell me that, we don't know where Apple, the share price is going to be over the next 3 months, but he definitely is long on this stock. He thinks it's the one best place where he wants to keep his money. That's why it's such a large position. And he thinks it's going to continue to compound. Now, the valuation is a different thing. We've seen Warren Buffett quarter to quarter, year to year, chop certain positions just based on valuation, but he's not saying that right now. And because Apple is the largest component of the S&P 500, I think that bodes well for the broader cap weight index, which everybody wants to hate on right now. I think the issue is that everybody hates that they don't own only 5 companies of the S&P 500, but I don't think it's time to necessarily ditch out on the S&P because of that.
Lee, what about some of his comments? I mean, Apple clearly has worked out for Buffett. What did you make of what he had to say about streaming? Because he was a little bit much more critical of what we have seen in that space, yet he's sticking with his investment, has stuck with his investment in Paramount.
You know, the problem with value investors, we all stick with some companies that we should sell, and we sort of kick ourselves in the head. Even 92-year-old Buffett will do that too. Here's what we need to know. Buffett's very clear. There's not going to be a bunch of new eyeballs coming to streaming, right? We're not going to have, a billion new people coming to streaming. And he told this story about the gas station that he owned when he was 20. Like when we were teenagers and owned gas stations and things like that. And he said his gas station out in Omaha, his profit was determined by his larger competitor, right? And he's saying streaming is the same way. You have big players and none of them want to quit. And you can tell Buffett's frustrated with it. He wants to shake out some of these weak players, and they're not being shaken out. And so I understand that pain. I own Disney, right? Disney Plus, Hulu. Streaming's a big reason why I own that Disney stock. He owns Paramount because of streaming. But as long as we have these major players that are basically what's happening is every competitor is keeping the ability to profit from everybody else. So I think you have to stick with the top 2 or 3 streamers and hope that we eventually become profitable. But you'll notice he's not selling Paramount. He's not. He just doesn't like the prospects because of that dividend cut.
Yeah, just hope that they become profitable. That's a big one there, Lee. Lee Munson, Portfolio Wealth Advisors President and CIO. It's good to talk to you today.
Thank you.
Well, coming up, about 30 minutes left in the trading day. We're going to take a look at a few trending tickers before the close. Stay tuned. We'll be right back.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Tyson, Six Flags, and Zscaler. Let's kick it off with Tyson here. Shares are plunging today, hitting the lowest level that we've seen since the start of the pandemic. We're looking at losses of just over 17%. Now the move lower coming after the meat producer cut its guidance for the year. Higher costs, declining consumer demand. 2 big reasons for this here. Chicken, pork, and beef divisions all facing challenges. Clearly a tough time here for Tyson. It was Tyson's first quarterly loss since 2009. The headwinds could likely persist here for some time. We got some commentary on the earnings call here. CFO John Tyson telling analysts that this is going to be the case at least for the remainder of the year. Over the past year, we're looking at losses of just over 44% at Kiko here. So the fact that business might not be improving anytime soon, clearly worrisome here for the company.
Yeah, no question about that. It really is all about protein, right, for Tyson. And chicken just is not doing well right now when you think about commodity prices there. A few things here. You point to the rising cost here, the cost of feed rising from a year ago. They've also highlighted concerns around the avian flu too, saying key export markets remain closed. So some really, really tough headwinds there for the company. We should say, you know, they've sort of said, look, while the protein market is challenged, they've got other areas they can focus on. That they saw strong performance in their branded food business, but no way to really slice it here. When you think about Tyson, it is all about chicken and meat, and that just simply isn't doing well right now.
Exactly, Kiko, and it's interesting to see that sort of being projected out for the entire year, and I think that was kind of the key point to highlight here. Also, stagnant demand for pork. I don't know about you guys. Maybe we'll get some deals on pork. Personally, a fan of pork. I know those prices have been coming down, though, it said, to some extent, so maybe it's cheaper than chicken. But the other thing, too, I think to point out there, when we think about earnings as a whole, and JJ Kinahan was pointing this out this morning, when you think about Tyson's earnings, is we haven't had a lot of retail earnings yet either, and sort of as the story shifts in earnings season here, what we see for overall outlook moving forward in these different style companies that are reporting now. We're sort of moving away from tech earnings now and getting back into what the consumer has to say. So we've seen these earnings beat, but maybe that story will change as we look at the different companies over the next couple weeks. And speaking of that, a company that did beat my play today is Six Flags. Shares of the theme park operator trading higher today as the company reported better than feared earnings during the traditionally slower winter months. Despite attendance down 5% compared to last year, total guest spending and admissions spending per capita were up compared to the first quarter of 2022. This drove revenues of $142 million, up 3% last year, and nearly 9% above street estimates. Six Flags CEO saying that there continues to be a growing consumer demand for local out-of-home entertainment. And Shauna, the other thing I wanted to point out here that is interesting is Six Flags piloting this dynamic pricing program. So the way this works is prices are going to fluctuate now based on how much demand there is. It makes a lot of sense to me. I know you're a sports fan, Akiko, you're a sports fan too. This sort of reminds me of how that works, right? When there's a less popular day or less popular game to go to, you get to pay cheaper prices and maybe you can get more people through the door. It seems like that's what Six Flags is trying to do here, and maybe we'll bring more people in during like that winter style month.
Yeah, exactly. And if you take a look at the trend, you would say that they're certainly off on the right foot here. When it comes to the pricing power, though, I think that is what the street is, I don't know if it's fair to say, taking issue with, but not exactly sold on whether or not this is going to be successful. Stifel was one of those teams out saying today that they're pretty much still on the fence about this, but they did say that the last 2 quarters give them some hope that Six Flags is on the right track. But this is another play. When we talk about getting a good look here at the consumer, people are going out and they're still spending on things that are fun, discretionary, not so much staples. So I think these results surprising the street just a bit in terms of the resilience or the improvement that we have seen at Six Flags. Attendance, like you said, at least revenue in terms of attendance, that jumped on a 10% basis. Spending on park admissions declined, though, in overall attendance, which, Akiko, they're pretty much just blaming on the weather. They're not too worried about that.
Yeah, this is a really interesting one for me, guys, because, we've been talking about where consumers are willing to spend. We were talking about travel earlier, about with those high ticket prices, are people still going to shell out money to travel? You mentioned what we heard from the company saying there's still high demand for local out-of-home entertainment. That's going to be something to watch going into the summer season. It's not cheap, by the way, to go to these amusement parks. Six Flags is at a lower price point with, compared to Disney, which is not saying a whole lot because that's pretty expensive. All right, let's talk about my pick here. We're talking about Zscaler. The cloud security company provided an earnings preview that pointed to better than expected results for Q1, and that led to a big lift in the stock there. The company now expects revenue of $415 million to $419 million in the April period. That is well above what the street was expecting. Now, the number investors are focused on is calculated billings. That is the amount charged to customers for subscribing to the company's cloud platform. Zscaler boosting that revenue outlook for the year significantly. The positive sentiment of Zscaler giving a lift to other cybersecurity names, including CrowdStrike. But Josh, what's also interesting to me is so much of this is about managing expectations. And the company did say, look, we're not likely to see significant demand from a lot of these companies who are pulling back on spending. They also announced cuts. And here we are talking about better than expected demand. We'll see if it is really the strength in the company or it is about lowering the expectations. in anticipation
Kiko, we're in
of
the
what we
middle
saw
of an
this quarter.
earnings season where earnings are declining on a quarterly basis again, yet over 70% of the S&P 500 have beat street expectations, right? So I think that sort of gives you an overall look into how this sort of works and the way to manage that. And stocks haven't moved that much on some of those movements either. But yeah, you're right. It is sort of a base case and how to manage things properly. But I do think it is a little bit something about the cybersecurity space too, Shauna, and the overall macro environment and where companies are going to be willing to spend. I don't think cybersecurity is a place that you're going to cut down spending. So I do think, at least in the customers they do have, and maybe some new customers, they'll be able to keep growing that revenue line because that's something that companies do need.
Yeah, certainly it is something that companies do need when they are adjusting their spending plans. If they do already have a presence, a large presence in that space, you're right. The likelihood of them cutting back on that versus something else that's viewed as more discretionary, you're right. They aren't going to pull back at least to the same degree. But on the flip side, though, I think the narrative and really what has been surrounding so many of these cloud players has been the lengthening sales cycle. So yes, they will be able, hopefully, to retain some of the clients that they already have, but they won't really be able to expand their business maybe as rapidly as we initially saw. And of course, we've also seen that reflected in some of those larger tech giants.
Well, that's why you've seen the stock is still down 10% over the last 6 months. So we're really seeing a recovery today more so than a surge in the intraday.
And we'll see whether or not it actually holds when we get the full results in just about a month. All right, still to come, the debt ceiling drama with Eurasia Group founder and president Ian Bremmer. He'll join us next. Stick around.
I think the context of the debt ceiling now kind of coming due, becoming more salient, is going to make for potentially a lot of weird things to happen in financial markets. So we should be extra attuned to that, and let us hope they can just get past this and raise the debt ceiling so this isn't a self-inflicted wound of the most grievous kind.
That was Chicago Federal Reserve Bank President Austin Goolsbee on Yahoo Finance earlier today, addressing the need for Congress to raise the debt ceiling. Now, President Biden will meet with top congressional leaders Tuesday to try to come to an agreement. Democrats want to raise the debt ceiling without qualifications. Republicans want to see spending cuts before considering raising that limit. And lawmakers have until June 1st to take action. That's when the Treasury Department says the U.S. will run out of money to pay its bills. For more on this standoff, let's bring in Ian Bremmer, Eurasia Group founder and president. Ian, you know, we've circled June 1st on our calendar because the Treasury has said that's sort of the date where the U.S. is essentially going to default. But you've said that's kind of a conservative estimate. What are your models telling you about what that X date is?
Yeah, the economists don't buy June 1st. Members of Congress don't buy June 1st. Our own Eurasia Group internal economic model thinks later, sometimes in mid-June at earliest. So in other words, there's less incentive to come to a deal or punt before that June 1st X date. But nonetheless, it is coming soon, and the market implications are going to be real.
Obviously, nobody wants to be blamed for a debt default, and we've got this meeting at the White House tomorrow. I mean, who's in a riskier position? I mean, if you think about Kevin McCarthy, he's got a very fragile party right now. He's obviously worried about his position as well. Is the pressure more on the Republicans than the president?
The pressure is more on McCarthy individually because he has such a narrow majority and his party is so fractured. And you saw how hard it was for him to secure the speakership, also how hard he was willing to fight for it. He could easily lose his job over this. That's obviously not going to happen to Biden. And any given member of the Republican Party has their own more narrow political interests they're willing to look after. So if anyone is in the hot seat here, it's going to be McCarthy. But what's really going to happen is that over time, as we get closer to government shutting down and therefore essential services that reflect 8% of the U.S. total economy, which means constituents are going to be really angry at their individual members of Congress if that happens, because they will be maximally inconvenienced. That's when you'll start to see people buckle. We aren't there yet. And the whole problem with this entire debt limit crisis is until you create a crisis that feels real and causes actual pain for the people that are voting, they are highly disincentivized to come to a deal.
Ian, it sounds like you think both sides really have a lot to risk. The American people, obviously, a lot on the line here when it comes to the personal impact. And this, of course, comes on the heels of a new poll out from Washington Post and ABC saying that President Biden's approval rating hitting a new low. He's trailing behind Trump and DeSantis potentially here in 2024. What does that tell us just about where the priorities should lie for the Biden administration and what the next year could potentially look like?
And that Biden should look like a centrist. So ultimately, he should be more incentivized towards a deal to be a responsible person that gets this done. That is, of course, how he won back in 2020, but still not until there's real pressure that forces the GOP to the table, and they're not there yet. But look, anybody out there, and as you know, I travel around the world, I talk to a lot of foreign leaders, and very few of them believe that it is plausible that President Trump, after January 6th, after 2 impeachments, after all these court cases, could possibly win again. It is likely he's going to get the nomination. It is absolutely possible that he can be president a second time. And anyone that wasn't believing that just needs to watch that poll. And that's leaving aside what Biden's health is going to look like over the course of the next 2 years, 18 months. So this is a really big issue, and people need to actively adjust their risk assessments as a consequence. I mean, I was thinking about the big speech that Jake Sullivan, the National Security Advisor, gave last week about the new Washington consensus. And the biggest challenge with rolling out a strategic policy plan, I don't care how well thought it is that if you don't believe as an ally or as an adversary of the U.S., that the Americans are going to be credible to hold on to any policy they have in a couple of years' time. Nobody listening to Xi Jinping thinks that. But for the United States, there is proximate domestic political risk around all of this stuff.
Yeah, and Ian, speaking to that, when we talk about the confidence in the government and government officials and business leaders, we have been looking at the polls now. That has been declining for quite some time. What does that say just about the current environment, how that really shifts the strategy of either Democrats and Republicans, and how we potentially fix that issue?
Small business leaders are respected. Scientists are still respected. But frankly, the military, the serving military in the United States are quite respected. But overall, levels of trust for politicians, for mainstream media, for individual CEOs has gone to the toilet in the United States. Some of that is general polarization of the House of Representatives and the corporate mainstream media. I think those are a big piece of it. Part of it is social media and the drivers of. I was just looking today. There was a wonderful poll that came out. I think it was Pew Research that was looking at how Democrats and Republicans self-identified do or do not trust different aspects of the media. And the Weather Channel came out number one, which of course is almost always wrong, but we trust them to be wrong. So that's useful. But after the Weather Channel, PBS was number two. And it's kind of interesting. I saw the poll on Twitter, and of course, PBS is the one that doesn't tweet anymore because Twitter decided to take them on as state supported. I mean, literally almost everything one could do in an environment to create mistrust for the way information is disseminated and incorporated into your worldview is happening at speed right now in the United States. So when you say, what can we do to change it? No. It's what can we do to make it worse? Because that's actually where we're headed.
Well, that's on a negative note there, Ian. Let's talk about the new Washington consensus. You just mentioned Jake Sullivan unveiling this. This is essentially the National Security Advisor talking about the new approach that the administration is now taking towards China as one of not decoupling, but of de-risking, reducing the exposure to China. You don't just talk to lawmakers, you talk to business leaders as well. What are you hearing from them about how they're viewing the Chinese market right now?
I think that de-risking is the way that many CEOs are thinking about the Chinese market right now. They still believe in it. They still believe that China is likely to be the largest economy in the world within, say, 6 to 10 years. But they also do not have a lot of confidence about what the regulatory environment, the legal environment will be for them to operate inside China. And they also don't have a lot of confidence of what the sanctions environment, the regulatory environment will look like in the United States towards China. And in that regard, they're not taking investment out of China, but they are pausing or reducing the scale of increased investment that they're making into China right now. Now, having said that, let's keep in mind that U.S.-China trade right now is at historically highest levels it's ever been. And you would never know that from going to Washington and listening to policymakers.
Yeah, certainly. And also, Ian, there's certainly been a shift in rhetoric when it comes to China and the role that China could potentially play in peace talks with Russia's invasion of Ukraine. At least there has certainly been some shift from the U.S. and a number of its allies. You're out with the paperback launch of The Power of Crisis, a new epilogue on the Russia-Ukraine war. I'm curious from your perspective, we have certainly been hearing signs that Ukraine is starting to take the counter-offensive. Where do we stand in this war, and how do you see that potentially going?
So we have had an extraordinary amount of alignment between the United States and its allies on the Russia-Ukraine issue over the last 15 months. I mean, really far beyond what anyone could have imagined in terms of the military support for Ukraine, in terms of the economic sanctions and other related punishment, the freezing of assets of Russia, and also just the general diplomatic engagement and transparency among all of NATO, among all of the EU. I mean, even 27 EU states during a war saying, we want Ukraine to join the European Union. That is quite a statement, staggering for all those countries, even Hungary signing up for that. Having said that, the war, I mean, no one in Ukraine really believes that they're going to be able to take all of the land back that the Russians have stolen from them. So how do you get from here to a conclusion? And what the Chinese are now doing, after Xi Jinping has belatedly, but nonetheless, spent an hour on the phone with Zelensky on the anniversary of the Chernobyl disaster, nonetheless, And Xi Jinping can now publicly say, I'm the one guy with global influence that can have a strong high-level conversation with both Putin and with Zelensky. No one in the West can do that. And when we get past the Ukrainian counteroffensive, we'll see how successful it is. You're going to see not just the Chinese, but an awful lot of countries in the world say, look, it is time to start talking. It's time to try to get a ceasefire in place. The Ukrainian government probably won't support that. Lord knows the US won't support that, but there'll be a lot of voices that do, maybe including the French, by the way. And I think that Xi Jinping today is diplomatically in a much better position than he was in 6 months ago, 9 months ago, 12 months ago, when he felt a little sheepish about his close relationship with President Putin. That is less of a liability in Xi Jinping's mind right now.
All right, Ian Bremmer, we really appreciate you taking the time. President of Eurasia Group, also author, The Power of Crisis. Thanks so much.
Good to see you.
Coming up next, another round of Disney versus DeSantis. We will break down the latest in the seemingly never-ending battle on the other side of the break.
It's a big week for investors. Earnings, inflation data, and debt ceiling negotiations. Here's a closer look at what you need to know in the week ahead. First up, with the June 1st debt ceiling deadline fast approaching, President Biden is set to meet with congressional leaders on Tuesday in hopes of restarting negotiations. Disney is just one of the high-profile companies that will report earnings this week. Investors will be closely monitoring this report following the recent wave of layoffs and cost reductions across the entertainment giant. Airbnb, Rivian, Krispy Kreme, and Beyond Meat are also on tap to announce their quarterly results. And Wall Street will be watching for the latest round of consumer numbers. Have prices hit their high point? We'll break down key inflation data when the Consumer Price Index, or CPI, is released, and if consumer sentiment continues to rebound despite economic uncertainty. Stay tuned right here on Yahoo Finance for everything you need to know.
The drawn-out fight of Disney versus DeSantis. The media giant is expanding its federal lawsuit against Florida Governor Ron DeSantis. Yahoo Finance's Alexandra Canal has those details for us. Hey, Ali.
Hi, Shauna. Yeah, so the Disney amending its lawsuit to include the latest comments from Governor DeSantis. And basically, they are attempting to further add to that narrative that DeSantis's moves are in direct retaliation against Disney over the company's stance to Florida's Parental Rights and Education Act, otherwise known as the Don't Say Gay law, and that infringes upon its free speech. That is what Disney is trying to claim. So according to the complaint, which was obtained by Yahoo Finance, it specifically cites a direct quote from DeSantis last week, which reads, "This all started, of course, with our parents' rights bill." So again, the direct retaliation piece of this equation. Now, on top of that, this amended complaint comes after DeSantis made moves to void Disney's development deal. That was that last-minute 11th-hour agreement that Disney struck that would basically allow it to build on its land and the surrounding properties without any interference from the current board. So we're seeing this tit for tat, Disney basically saying, if you strike us, we're going to strike you back. I'm sure this is going to come up on the earnings call, which will happen after the bell on Wednesday. So a lot of things to keep track of with this company.
Yeah, Ali, I'm curious just how investors you think have been viewing this. We have about a minute here until the closing bell, just in terms of the fact that it hasn't really had any direct impact. It doesn't seem like, at least yet, on the stock.
No, investors seem to be shrugging this off. Now, Bob Iger, he has addressed this. He addressed this on the shareholder meeting. He has addressed this multiple other times with town halls with employees. But like you said, hasn't really had a direct impact on the stock. But I think investors have really closely been watching their layoff plans, their restructuring plans. That's what's been on the mind of these shareholders. But again, we'll see what happens on Wednesday.
We will. All right, you're looking at shares of Disney up just about 2.5%. Ali, thanks so much. Let's take a look at where things stand right now in the final seconds of the trading day. We're looking at the Dow off just about 0.2%. The S&P just above the flat line as we ring that closing bell. The Nasdaq also holding on to some of its gains of the day, up just over 0.1% in terms of the outperformance that we're seeing. Communication services, the outperformer there in terms of S&P sectors, with the XLC closing up just about 1%. We're also looking at gains from consumer discretionary and financials. On the flip side, real estate, the worst performer of the day. Let's get a check-in on some of the biggest movers of the day. First up, Tyson Food. That stock trading to the downside, closing off just over 16%. The move lower following a surprise loss for the second quarter, mostly coming from its chicken segment. The company also lowering its fiscal 2023 revenue outlook by about $2 billion. Akiko, a number of headwinds here for the company, including consumers pulling back on their spending. People simply are not buying meat or as much of it as they had been in the past. And then also just higher prices here faced from Tyson Foods from a production standpoint. Clearly one of the risks ahead, at least in the coming quarters.
Yeah, I mean, the higher prices or consumers pulling back certainly hurting the company. We've heard from so many companies who've said we've been able to push higher prices because consumers are still willing to spend. That's not the case with Tyson Foods. In addition to that, they've also had to look at some of the key export markets being closed down because of the bird flu. So a number of headlines there for Tyson Foods, adding to the declines that we've seen in the market today, with that stock down about 16%. Zscaler going in the opposite direction, though, up in a big way today, closing up more than 20% after the cybersecurity company announced it is expecting better than anticipated results for its fiscal third quarter. Zscaler, which is not expected to report earnings until June 1st, is projecting revenue for Q3 to be between $450 million and $419 million, while its prior outlook was for $396 million to $398 million. And Shauna, we were talking about the stock earlier today. Part of this is about managing expectations, because Zscaler did talk about some of the challenges with some companies maybe not investing as much in cybersecurity. At the same time, you could argue just because a company is struggling, you're not necessarily going to say, all right, we're going to take our money off the ball here in terms of security. So we've seen not just Zscaler up in a big way, some of its competitors also getting a lift on the back of this preview of those results expected out in June.
Yeah, certainly. I think the street was very surprised by this guidance, what we're getting, and we could see that reflected in the move today, up just about 20%. Mizuho was out with a new note saying that given the state of macro environment, it's safe to say that this outcome was hardly on any investor's radar here, really putting it in perspective. Although it isn't out of the woods just yet. Yes, there is some relief here, and that's reflected in today's gains, but the macro environment seems like it's going to continue to be challenging for Zscaler, other cybersecurity firms, at least in the near future. So a little bit of relief, but we won't see those strong growth numbers. Not as likely that we'll see those strong growth numbers here looking out into the second half of the year. I also want to finish with another mover today, and that's Virgin Galactic. Shares closing up just about 13%. The space tourism company saying that it is planning for a 4-member test flight to take place later this month, and that they do expect to launch its first commercial flight in late June. Akiko, there's been so much hype around Virgin Galactic, when exactly the timetables, what that's going to look like, what that demand potentially is going to look like, whether or not people are going to trust. But from an investor perspective, people are very, very encouraged by this headline out today.
I'm going to take it away from the investors, Shauna. Would you take that flight?
No.
The first commercial flight?
No, you couldn't pay me to take that flight. No, I'm too scared. I wish I could say yes.
Yeah, I feel like I would. I mean, this is kind of part of the conversation around Virgin Galactic for some time. I mean, why not go all in? But, there have been some concern that Virgin Galactic's been sort of trailing some of its competitors. So at least when you think about where the timeline is now with that first commercial flight set in June, it's going to be interesting to see where that stock moves from there, depending on how that flight goes. All right, crypto exchange Binance halted Bitcoin withdrawals earlier today. Let's bring in Yahoo Finance's Rochelle Akufo, who has the details for us. Rochelle, how do we see some of the moves on the back of that?
Well, so we're sort of taking a look at some of the takeaways from the selling action that we've been seeing in some of these cryptos, especially Bitcoin. You mentioned Binance, the world's largest cryptocurrency exchange, suspending those withdrawals, and that was due to too many pending transactions, according to CEO ZZ. He tweeted that the problem was due to an unexpected surge in Bitcoin transaction fees, which had fluctuated an 18x from last month. He also added in it was FUD, or fear, uncertainty, and doubt, also fueling this. But that skepticism and speculation about whether it was some of these big crypto whales selling their positions, that spread. So, of course, down went Bitcoin and dragged down other tokens with it on a day that already had a mixed picture in general for investors. Now, CEO CZ also tweeting, we're aware that some data are showing a large volume of outflows from Binance. This outflow, actually movements between Binance hot and cold wallets due to the BTC address adjustments. Now, if this had been just effective outflows, this would have marked the largest withdrawal in its history at over 162,000 Bitcoin, worth over $4.6 billion. Now, Julio Moreno, who's the head of research at CryptoQuant, he noted that these two transactions in question of 117,000 and 40,000 Bitcoin, respectively, were between Binance addresses. So putting those effective outflows closer to about 10,100 Bitcoin. So not as big of a deal as originally thought, but still a lot of skepticism here.
There's a lot of skepticism there. Rochelle, let's also talk about what we're seeing take place at Coinbase, because Coinbase shares were under a little bit of pressure today. The CEO there coming out, doubling down on criticisms of regulatory headwinds, also saying that they're not going to back down. They will gladly go face to face with the SEC. What are we learning there?
I mean, this is quite the turnaround. We had Coinbase saying they're not leaving the US. CEO Brian Armstrong walking back those earlier comments on the possibility of having Coinbase leave the US because of those regulatory headwinds. He told CNBC this morning Coinbase is not going to relocate overseas. We're always going to have a US presence, but the US is a little bit behind right now. In terms of examples you could look to, he praised the more thoughtful approaches, as he called them, in the EU for passing comprehensive crypto legislation, as well as the UK, he said, being incredibly welcoming as a reason why it's a hub that they've decided to serve as well. But of course, SEC still in the headlights there. Armstrong called the SEC an outlier in the way it's approaching crypto to curtail it rather than regulate it. But he says that these lawsuits, you look for a silver lining here, they offer a chance for more clarity, which will benefit the industry as a whole. Hopefully get some answers on some of these different criteria.
Yeah, Brian Armstrong has had some pretty strong words for the SEC on the back of some concerns around that regulation. All right, what's the latest coming out of DC when it comes to crypto mining?
Well, it's interesting because we thought we pretty much just had to look at the SEC in this, and we know that the Biden administration was looking at, not being fond of having people adding crypto to the 401ks. But now on the mining side, the Biden administration added the new digital asset mining energy, that's DAME, that's the excise tax, its proposal to its budget last week. So basically what will happen is after a phase-in period, crypto miners would face a tax equal to 30% of the cost of the electricity they use in crypto mining. Essentially, the White House saying, pay your fair share. Now, the White House estimates that in 2022, US crypto mining used about the same amount of electricity used to power the entire country's home computers or residential lighting. So to give you some context there. And of course, the United States, by far the biggest crypto mining country in the world. So this will really be a blow for crypto miners.
It will be something we will continue to track. All right, Rochelle, thanks so much. Well, coming up, sticking with D.C. here, the debt ceiling debate in Washington. How could it potentially affect you? We've got those details for you when we come back. The clock is ticking for Congress to raise the debt ceiling. If they fail to do so by the time the U.S. reaches the X date, the date the government can no longer pay its bills, it could have dire consequences, not just for the government, but for Americans, for you as a whole. So let's talk about it with Mark Hamrick. He's senior economic analyst at Bankrate. Mark, it's good to see you here. So there's a number of ways that it could affect our viewers. Let's just start with, more broadly speaking, when it comes to the equity markets, how big of a hit could some people's investments take?
No doubt a huge one, Shauna. It's good to see you again. I think, we've had some experience with this in the past where the stock market took a dive even approaching the X date, where it was resolved in 2011, obviously eventually recovered those losses. But I want to sort of caution people in the sense of thinking that this is all very quantifiable, because we're really talking about the equivalent of a disaster, the likes of which we've not had in the United States in our history. We had the loss of nearly 15 million jobs in March and April of 2020. That was a disaster. We had the great financial crisis. That was a disaster of another kind. And we're really talking here about a huge hit to the macro and micro economies, meaning we'd have a seizing up of financial markets and the financial system. We'd have a lot of people who are due money, whether it's individuals or businesses, that they would not be paid. And so I think there's an analogy here where we thought about going into the weekend of the Silicon Valley bank failure. We were worried about one significant bank not being able to essentially function, because the big worry was that businesses wouldn't be able to make payroll, and that would be sort of rumbling all across the U.S. economy. Now, multiply that by a factor that we frankly don't know what the number is, but many, many times over. And that's really the kind of thing we're talking about. And finally, to the point that you didn't ask about, this is all would be self-inflicted and unnecessary, because if anything, the debt ceiling has proven time and time again to be an ineffective tool in curtailing federal spending. So it does not inflict fiscal responsibility upon lawmakers. It just gives us another thing to worry about.
Mark, you talk about money owed there and what this means if we hit that June 1st date. 66 million retirees out there who are saying, well, what about Social Security? What can they expect?
Yeah. Well, I think it's not entirely clear what happens to them. I've seen answers on both sides of that equation, but let's just say that if Social Security recipients were not able to get their money, think about all the horrible consequences that would emerge from that, whether it's food insecurity, inability to get health care, and indeed, the health benefits that those people get could be interrupted as well. So again, if you want to inflict a great deal of damage on the American populace, this would be a very effective way of doing it.
Mark, is that the same for federal employees and also veterans benefits? Would they be in the same boat as Social Security and Medicare, it sounds like? Yeah,
we believe so. I've also seen some differentiation on the payment of benefits to members of the military, that may have some way of being carved out and protected. But nevertheless, all these cohorts that we're talking about end up being, any one of them alone is significant. But let's think also just about the fact that the federal government works with business across the spectrum. And, we're having problems in downtown Washington, D.C. just with the lack of return to office. Imagine if the federal government just stopped paying everyone that it was due to pay money to, and then sort of carry that out all across the globe. So again, totally unavoidable, totally unnecessary, and potentially very catastrophic.
Mark, we're talking about the worst case scenario here, where the U.S. defaults on its debt. There's certainly a lot of analysts out there who say we don't think it's going to come to that. Certainly the president doesn't want to have that happen on his watch. But what if we just go up to that line? If we're talking at the end of May, that no deal has still been reached, June 1st hasn't come yet, but what does that mean? I mean, can you talk about the more likely scenario?
Well, I don't know what the most likely scenario is. If I did, I'd say that. I would say right now, I'm betting that the most likely scenario is we engage in one of our national sports here, and that is kick the can once again, because that seems to be perhaps the simplest solution when people are trying to add some complexity to this, but also need a way out. In the negotiation process, essentially you need a situation not unlike Russia and Ukraine, where both sides needs to walk away with some degree of at least their own perceived respectability, including among constituents. But to your point, that eventuality could be very much damaging as well, because you may have some damage or declines in financial markets with respect to asset prices. You could have some distortions in fixed income, like we had with the raising of borrowing costs to the tune of $1 billion from with respect to the federal government in the 2011 instance. You might say that there are some not so worst case scenarios that are still quite bad.
Mark, you briefly touched on this earlier here, but when we talk about the cost of borrowing going up, more specifically, what does it mean for Americans who have a mortgage or those who have credit card debt? How much more could they potentially pay as a result?
It's impossible to quantify that, but what I would say is, we just had the senior loan officer survey out from the Federal Reserve a few hours ago, and that already found that there's less availability of credit right now and also less demand for it. And this would be a much more severe severing of that availability in this eventuality of, let's say, breaching the X date. We're already seeing distortions in the financial markets, and we're not anywhere there yet. And, to the point of the earlier segment on this, we also don't have a high degree of confidence what the actual X date is. But we do know that with slowing economic activity, there's less revenue coming into the federal government. And that's how one of the ways that we pay our bills when we're not borrowing. So what I think is that we're really dealing with a lot of unknowns here, a lot of uncertainty. And uncertainty is something that is really the antithesis of confidence. And we need confidence on the part of consumers and businesses. And right now, if you want to look at, let's say, the major source of uncertainty in the very near term, it is this debt ceiling issue. We have plenty of other sources as well that aren't quite necessarily as pressing that we know of.
Mark Hamrick, Senior Economic Analyst over at Bankrate. It's good to talk to you today. Appreciate the time.
Thank you.
Well, Disney is set to report its Q2 earnings after the bell on Wednesday. We're going to preview what to expect from the media and parks giant on the other side.
Elon Musk announcing that Twitter is looking to purge some inactive accounts. Dan Halley is here with the details. Dan.
That's right, Shauna. According to a tweet from Musk, basically what they're going to be doing is getting rid of some older accounts. He said that those that are inactive for years, so not necessarily if you've ditched Twitter for a month or two, but for quite some time. And he said that those accounts, once they're gone, will allow Twitter to open up those former usernames to more people. And so this is a way for them to attract users who potentially wanted those usernames and weren't able to do them, and also, frankly, save some cash because they're not going to have to operate those accounts that are no longer active. They won't have to support them. And so that may take some load off of their own processing. So it could help them on the server side of things as well. But this is just another one of the many moves that Musk has made at Twitter. There's no exact timeline, though, on when we would start to see these kinds of accounts change. And, Elon is kind of fond of making an announcement and then kind of slow rolling when it comes out.
We'll leave it at that, Dan. I won't ask any more questions further on Elon Musk. Dan Halley, as always, thanks so much for that. Well, moving on here to Disney. The company is set to report its fiscal Q2 earnings after the bell on Wednesday. Despite the company's recent layoffs and ongoing battle with Florida Governor Ron DeSantis, the House of Mouse is projected to report strong earnings growth. Let's bring in Jason Bazinet, the city managing director, to discuss. Jason, as we noted here, this comes on the heels of yet another round of layoffs for Disney, but all eyes are going to be on that direct-to-consumer business. What are you expecting on that number?
Well, just to frame it for you, remember Disney lost about $4 billion in the streaming business last fiscal year. Their first fiscal quarter, they lost about $1 billion in the quarter. And so no real discernible improvement, right? $1 billion of loss times 4 is another $4 billion loss. So what the street will be focused on is hopefully a sharp reduction in the direct-to-consumer losses. The company's pointed to about $200 million of smaller losses, so call it 800 million. And I think that's what the street will be focused on. If we end up with a much smaller loss, the shares, I think, will do quite well.
Jason, what do you think we're going to hear when it comes to Hulu? Lots of talk about what exactly that's going to look like here, just in terms of its future with Disney, whether or not it could potentially sell its stake. How do you see Disney addressing Hulu down the road?
Look, I was flabbergasted on the last earnings call, right, which was Mr. Iger's first quarter back, when he said everything was on the table when it came to Hulu. He was uncomfortable with what he called general entertainment, which pointed towards a potential Hulu sale. I think that would be a grave mistake. We would like to see Disney buy in the balance of Hulu it doesn't own, merge that with Disney Plus, rationalize some costs, and really create what I'll call a TV substitute on the streaming world. But I will tell you, I'm in the minority among investors. Every investor I chat with would be thrilled if Disney sold Hulu. So I'm in the minority, but if anything that Mr. Iger does tomorrow or Disney does tomorrow that indicates that they're more open to selling it, the street would applaud that. I think actually it would be a mistake, but again, I'm in the minority.
Jason, the numbers are going to be focused on the first quarter, but have to ask you about what's happening right now and the impact on Disney from the writer's strike. What's your assessment right now in terms of what this means, number one, from a financial perspective, but for Disney's content pipeline?
Well, remember, if you go back over all the writer's strikes, and I think there have been 6 of them in Hollywood over the last 100 years, they typically last plus or minus 100 days. The last one was a little bit over, I believe, 180 days. If you see that sort of delay, I think that's manageable because things tend to slow down a little bit during the summer months for new scripts. But if we end up with something that's more protracted, that goes beyond 150 days, beyond 180 days, it of course will be good for the costs, right, in the near term. And so you could paradoxically see earnings move up, but then it will begin to impact the top line, which would be bad. And so this is, I think, a highly contentious issue in Hollywood right now, because it comes at this strange intersection of sort of two technological things happening at the same time, right? The streaming world has sort of upset the sort of monetary algorithm that writers were accustomed to. It's also reduced the periodicity or predictability of what a writer can expect to generate, because they're moving from show to show to show, unlike the old linear days. And then third, you've got artificial intelligence out there, right? Which a lot of investors are focused on that could play a role. And the writers themselves are trying to limit the use of AI in the context of writing scripts. And of course, the management teams want to preserve all that optionality. So you have a lot of moving parts, all of them underpinned by technological change.
Jason, let's switch gears here a little bit and talk about their parks business, because that was very strong last quarter, up 21% on a year-over-year basis. What do you think that number is going to look like on Wednesday? And do you think that momentum is sustainable?
Yeah, everything we've seen out of the live and experiential part of the ecosystem has been incredibly robust. The street's been talking about a recession for a little over a year now. We're just not seeing it in any of the numbers. Maybe there have been some advertising numbers on the B2B side that have been soft, but at the consumer level, it's been quite resilient. And I would say that one of the things that surprised me during the great financial crisis with Disney is, there we were shedding 700,000 jobs a month. The S&P 500 was around 670 points. Everyone's 401k was a disaster. Their home values, many people are underwater on their mortgages. And the parks business didn't do that poorly. So I think a plain vanilla recession, even if we have one, is fine for the parks. For the quarter, I think they're going to have great numbers.
So looking to where we are right now, what do you think is going to be the big driver moving forward? Is it really still going to be about cutting those losses in streaming, or can we expect, a significant bump as we go into the summer season with parks?
Yeah, I think you could see a bump in parks, but for sure, I would say 80% of the narrative on Disney stock is shrinking those DTC losses, because if you looked at the PE multiple that Disney's trading at using historicals, it would look like a very expensive PE multiple. But you take those $4 billion of losses and you drive them towards zero, and you're going to get a lot of earnings growth, right? And then the multiple doesn't look so expensive. So anything that Disney can do to shrink those losses faster is going to be the most important thing for the stock, for sure.
All right, the stock off nearly 8% over the last 3 months. Jason Bazinet, great to have you. Thanks so much for joining. Coming up next, PayPal shares on the move following its latest earnings release. You're looking at a drop of just about 4%. We've got the numbers for you when we come back.
Well, Lucid Group kicking off a busy week of earnings in the EV sector this week. Lucid shares trading lower in after hours, down more than 7% here after the EV maker's Q1 results missed estimates on both the top and bottom lines. Joining us now is Dan Levy, Barclays Senior Autos Analyst. Dan, I realize you don't cover Lucid, but and they compete at a higher price point. But I'm curious what you make of the number that we're getting there, and what does that say about the momentum within the EV space right now as a whole?
Yeah, thank you, Akiko, for having me. Look, I think that and what we've seen with Lucid is guiding to the lower end of its production guidance. I think one of the broader trends that we've seen in the EV world is that some of these production ramps are challenging. And it's not just Lucid. We've seen it at Rivian. We've seen it with the legacy automakers where there's been some lumpiness in the ramps. Obviously, there's supply questions as well. So I think part of this gets to some of the questions of ramping on EVs, which hasn't been easy, frankly.
You mentioned the challenges that we've seen at other EV companies. Rivian, one that you just mentioned there, certainly one that you seem pretty bullish on, though, saying that has the best potential to pursue the title as the next Tesla. They've also got some challenges there on supply side as well as ramping up right now. I mean, what do you see there that makes you positive? You've got an overweight rating on the stock right now.
Yes, I do. And I think what keeps us positive on Rivian is that it's connected to all the right trends. We know that the world is electrifying. I mean, we can debate the shape of the curve, but we know that it's electrifying. We know that in the path to electrification, some of the legacy automakers have real challenges they need to address in terms of manufacturing, transition, and transitioning out of combustion engines. Rivian doesn't have any of those. The product is amazing, and they own a lot of their technology. So we appreciate all of those pieces that make it what we think to be real structural strengths. But to unlock the real value of the stock, we also acknowledge that it's going to have to overcome a number of challenges. Notably, the losses have been quite high. They lost something like $5-6 billion of EBITDA last year. They're going to do another $4 billion EBITDA loss this year. The pace of cash burn has been something to watch. And then obviously, what we're watching for, demand has not been an issue, but it's something that we're monitoring, given that is one of the newer developments in the EV realm today is questioning, the health of demand. This was previously an industry that was defined by supply and it was fully supply constrained. Now it's demand constrained. And that's something, we want to just be watching with Rivian to make sure that the demand is still there, the backlog is still healthy.
No question investors have turned a more critical eye on the sector as a whole. It isn't just about the growth anymore. It is about profitability. When you look at a name like Rivian, how do you think the company steers things in that direction?
Well, Rivian is pivoting in some ways from what the approach that they took at the time of the IPO. Clearly, the message of the market at the time of the IPO, which was just over 18 months ago now, was grow at any cost. And so accordingly, they took on certain approaches that they've since pivoted away from. And so part of the path ahead for Rivian is certainly ramping on volume. That's certainly a key piece of it, is the volumes are still constrained. We need to see them going above 10,000 units a quarter. They've guided to 50,000 units this year. I think there's some hope that potentially they could produce closer to 60,000 units. I mean, that has been out in the media already. But then there's also questions about reducing some of the content or getting some breaks on pricing from suppliers, really to help reduce some of the COGS. I mean, this is a company that last year, even if you strip out the cost of labor and D&A, lost $40,000 per vehicle. And so there's definitely some work ahead. Our hope is that they're taking the right steps to address that profitability and to achieve their target of getting to gross margin break even next year.
Dan, let's talk about the leader in this space. That is, of course, Tesla. You've still got an overweight rating on the stock right now, but this is a company that has gone through multiple price cuts this year until most recently they had a price hike Does that suggest we've finally seen the floor on pricing?
No, we don't think that this is the floor. The most recent price hike may have just been a way to signal to consumers that there's a little bit of stability for now. But our view is that as they continue to ramp on supply, which has been, Elon made it pretty clear on the last earnings call that they want to ramp on volume. The more supply you have hitting the market, there's probably going to have to be more price cuts to unlock that supply. Our view on the stock is that, look, the current fundamentals are challenged. We are seeing the question of what's the floor on margins, what's elasticity of demand. These are all real questions, and it's making the fundamentals somewhat challenging now. We do think that there's negative EPS revisions ahead for 2024. We're at roughly $4 of earnings next year. Consensus I see is closer to $5. What keeps us positive, though, is that they are still the leader in this transition. We know this transition is happening. We think they're going to soak up a lot of share, and really the name of the game for them is aggressively reducing costs. So there's some challenges on fundamentals right now, just given what's happening on demand, but we think that eventually they will get past this.
Finally, I want to ask you about some comments that we got from Warren Buffett over the weekend when he was asked about EV investing. He said specifically, you won't see anyone that owns the market. It's partly why he's not very bullish on the sector itself. You talked about Tesla being the leader here, Rivian potentially one to follow. But as we see more and more competitors flood the market, are we going to see it increasingly fragmented, or is this a market that will still see big leadership from a name like Tesla, if not Tesla, another name?
We think that Tesla is going to continue to grow a lot of its volume. Look, I think Warren Buffett's comments are correct that the auto industry has historically been very challenging industry, and it's one where automakers have been challenged in really differentiating themselves. I think what we've seen from Tesla, though, is a very clear lead in approaching cost, driving costs down, really figuring out the dynamics of the software-defined vehicle in ways that others have struggled. And so it's not to say that they're going to completely displace others, but there is a lot of share that they will gain. That's what we think is the real opportunity for them, is they're just still so far ahead on cost and in unlocking that potential that they're still a winner in this race.
Barclays Senior Autos Analyst Dan Levy, good to talk to you today. Got a busy week ahead of you. Thanks so much for that. Let's go to Shauna now, standing by with the latest earnings results from PayPal.
Yeah, Kiko, taking a look at the stock here in extended trading, off nearly 4%. A bit surprising because PayPal did beat in Q1. It also raised its full year forecast. Despite that, though, we are seeing some pressure on shares in extended trading. And I think that specifically as a result of what they had to say about the current quarter. Second quarter adjusted EPS is at the low end of the range of $1.15 to $1.17. The street was looking for $1.17 here. So that could be one of the reasons why the stock is under pressure here in extended trading. But again, for the quarter, it was a pretty solid number here from PayPal. Their total payment volume was up 10% on a year-over-year basis. They also boosted their full year profit guidance here, which may have caught some on the street by surprise, given the fact that so many consumers have been pulling back a bit on their spending, or we were expected to see a larger pullback on spending in Q1. And we also want to point out that PayPal did cut 2,000 workers, announced plans to cut 2,000 workers, citing that macro slowdown, needing to make some adjustments here to their business, given the fact that we are seeing a broader slowdown here. But PayPal, again, shares of Kiko under pressure, off just about 4%. I think a lot of that has to do with what they're planning to see or what they expect to see in the current quarter adjusted EPS.
Yeah, PayPal, always a good indication of the consumer, at least a good pulse. It's going to be interesting to hear also if we hear any commentary from the company on succession plans. Of course, people watching, Dan Schulman, who's leaving at the end of the year, says that he's planning to leave at the end of the year. So we'll be listening for any comments on that front as well. Well, coming up, we check in on a few tickers that are moving after hours. We'll be right back.
Let's take a look at what is trending after hours. We've got three names for you: PayPal, Palantir, and Lucid. Kicking it off with PayPal, we're looking at losses of just about 4%, despite the company beating on both the top and bottom lines. Its 2Q adjusted EPS outlook, though, coming in at the lower end of what the street was looking for. PayPal now saying that it expects to see $1.15 to $1.17 a share. The street was looking for $1.17. In terms of the numbers, though, for its most recent quarter, spending heading in the right direction here. The company boosting its full year profit guidance. CEO Dan Schulman saying that the company is off to a very strong start. Active customer accounts totaling 433 million. That's up compared to a year ago. In terms of what we will be listening for on the call, CEO Dan Schulman, he is expected to step down at the end of the year. So any talk, any info on who could potentially be taking over for him, of course, will be a focus here for shareholders. You're looking at the stock up just about 6% since the start of the year. Moving on to Palantir, that stock up 25% right now in extended trading. Certainly a strong quarter here from the company, beating on revenue, but the big headline, raising its full year forecast and also saying that it's going to be profitable in each quarter for the year. CEO Alex Karp saying that engagement and demand for its new AI platform is without precedent, and we know that that is going to be rolling out here in the coming weeks. Year to date, we're looking at gains of just about 20% over the last year. Palantir, though, still in the red, off about 18%. And rounding it out with Lucid, that stock off about 8% here in extended trading. Revenue missed the street's expectations. Also, production guidance coming in at the low end of the year. It now expects to make 18,000 vehicles this year. They'd initially guided for 14,000 vehicles, so a reduction there. Obviously, one of the things that is weighing on the stock. In a March filing, also, the company said that it would be cutting 18% of its workforce as it looks to reduce costs. Year to date, Lucid had been up just about 12%. Akiko?
Well, Equinox is flexing its muscle when it comes to hiring. The luxury fitness platform says it plans to hire 5,000 performance coaches around the world over the next 2 years. Equinox President Scott DeRue joins us with that announcement. Scott, that would seem to certainly suggest a positive outlook when it comes to demand. What are you seeing on that front right now?
Well, thank you for having me first and foremost. We are seeing extraordinary growth in the business. We're seeing extraordinary growth and demand for coaching. And as a result of that, we're really excited about what we're able to do for our coaches around the world and expanding our team.
Then personal trainers, it's a lot. Do you think you're going to have any trouble finding the number of workers that you need?
We don't. And the reason is twofold. One is we're creating partnerships with organizations such as Hiring Our Heroes, which is one of the largest organizations that helps military veterans transition into civilian careers. So we're creating partnerships that are going to bring new talent into personal training and coaching. And then when you combine that with our commitment to education, training, and development, we have our Equinox Fitness Training Institute, world-class institute that helps onboard and educate the very best premier coaches in the world. And so when you put together the talent partnerships combined with the coaching, training, and education, we feel really bullish about where our personal training business is going and our overall business.
Scott, where are you seeing that demand coming from? When you talk about the demand in personal trainers, I mean, we always think about Equinox as more of a high-end brand. You certainly compete at a much higher price point than other gyms.
Yes. So much of it is born out of what we're seeing in the overall business. So if you look at 2022, we saw average weekly check-ins increase over 65%. And as we've begun 2023 and the first quarter, we're seeing that pace continue and even accelerate in many of our markets. And then our members are looking for results. They're committed and they want the very best coaches in the world to help them achieve those results. And our coaches, again, back to the talent, the education, the coaching and training that we provide, they're able to partner with our members to help them deliver the results that they aspire to. When you put all of that together, our personal training and coaching business is growing faster than probably any other in the world.
Scott, who though is fueling it when we break it down by generation? Is it Gen Z? Is it millennials? Is it Gen X all the way up? And more specifically, are you seeing at all discrepancy regionally speaking?
We're not seeing discrepancies or differences regionally. We are seeing a difference in behavior in terms of different segments of the market, if you will, but it's really across the board where we're seeing that growth. But what's really exciting is some of our newest members are increasing their demand and aspirations with regards to coaching. And so it's not as much about age as it is this newfound commitment where really health and wellness is such a big part of our lives. And I think over the last several years, that has certainly become an even bigger part of our lives. And so people are aspiring to this transformation really around health, wellness, longevity, but they don't necessarily understand where to go or how to do it. And so they're looking for partners in helping them achieve their goals, achieve the results they desire. And so that's really fueling the demand for this highly personalized, curated coaching experience that we offer.
Scott, we've been really trying to get a sense of where the consumer is right now in the face of an economic slowdown. It does feel like there is a big divide between luxury and where the rest of the market is right now. Are we going to continue to see that divide get even wider if you're talking about health and fitness?
I think that's right. And we're seeing this across the luxury segment broadly, whether it's in fashion or in our case, in health, wellness, and fitness. And the consumer has the means and they want to invest in themselves. And so we are really the beneficiaries of that in the opportunity to partner with them. And so the commitment to health, the commitment to wellness, and this luxury segment that we play in, certainly the consumer has the discretionary income and they want to invest it, and they want to invest it in things that they're passionate about, that they care about. And for us, that's health and wellness.
Scott, how do you approach pricing at a time like this, given the fact that we are expected to see a slower growth in the second half of the year? Do you shift your pricing strategy at all, and how so?
Well, certainly over the last couple of years, past 18 months, we've certainly seen inflationary pressure. We've intentionally lagged our price increases to inflation. And that was really a commitment to our member community. Certainly as a business, we've on the other side felt the effects of that inflation. Hopefully we can navigate this inflationary period where the Fed and other entities we're able to navigate it such that we don't send the macroeconomy into a tailspin. We're certainly planning for the remainder of the year. If we were to see a slowdown, how would we respond to that? But again, I go back to the pattern and the growth trajectory of our business. From a membership gain perspective, we just had our best first quarter in the history of Equinox. And so we're seeing demand grow. Certainly we want to be prudent and plan as if that shifts, but we're seeing demand grow at rates that we haven't seen before.
All right, Scott Drew, always great to speak with you of Equinox. Thanks so much for joining. A warning sign for New York City's economy potentially here. New data showing that the return to office trend might be stalling out. There's a report out from Axios showing that the office vacancy rate is holding steady at roughly 60% compared to the levels that we saw in 2019. Now, it is important to point out that it is up about 10% from what we were looking at, the levels that we were looking at just about a year ago. But we have certainly flatlined, as you can see on that chart. And Akiko, I think the big question here is whether or not, if workers are under more pressure, if the economy does worsen, we start to see layoffs, whether or not employers at that point, you would think, are going to have the upper hand. And if they do, if they want to bring back their employees to the office, will that be what it takes in order to see more of a shift? Or is this simply as high as these rates are going to get?
Yeah, that's an interesting question because it really feels like companies as well as employees are kind of at a crossroads right now. For years, since the pandemic began, we have seen a very flexible work environment for these companies who wanted to keep those employees on board. But at some point, you've got to make a decision to say, look, this is our policy. You have to return to work and be okay with the idea that some employees may say, well, if that's the case, I just can't work for this company anymore. So you'd imagine the shakedown is going to take a little longer, but New York City probably a good example, a good indicator of the challenges a lot of companies are facing, that they had a ramp up compared to where they were in 2020, of course, but 2021. At one point, you hit a ceiling and you have to make a decision to say it is mandatory or it's not, and sort of decide where the productivity is going to be moving forward. But I can tell you, not really much better here in LA, although traffic is bad and you think that people are actually going back to work because of the traffic.
Yeah, I take the bus into work and I am amazed. It is completely full Tuesday through Thursday, although Monday this morning and Fridays, I'm normally one of 10 people on it. So I guess a lot of people really have that hybrid option, and that's what people are opting to do if they are given that chance.
Yeah, I mean, that's what we heard all last year, right? That it's going to be increasingly hybrid, that workers will have to come back on some days, but maybe have Friday at home. But we'll see which direction that moves in for these companies. All right, coming up, we get you caught up on the top headlines of the day. We're going to take a quick break here. We'll be right back. It is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. We are kicking things off with the debt ceiling. That is the big focus. With Tuesday, President Biden is set to meet with the big four congressional leaders at the White House. We'll also have both chambers of Congress back in session. You can expect negotiations to be coming fast and furious as the U.S. comes closer to being unable to pay its bills.
Tyson Foods shares sliding 16% today after its second quarter earnings missed estimates. The company reporting a surprise loss, also cutting its fiscal 2023 outlook, citing a, quote, challenging protein market.
And Virgin Galactic is returning to the edge of space. The space tourism company will launch its latest flight in late May with the hope of being able to start commercial operations next month.
And we drove shares today. All right, well, that does it for Akiko and I today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. We'll have all of your coverage leading up to and after the closing bell. Have a good night. you.